Chapter 13, Taxable Income and Additional Taxes. The following forms and publications are used in the research and development of this lesson. Forms and publications are available on your CD or at www.irs.gov. The following forms and publications are used in the research and development of this lesson. Forms and publications are available at www.irs.gov. Taxable income. This is reported on line 43, Form 1040, or line 27 of Form 1040A, or line 6 of Form 1040EZ. It is the amount of income after all adjustments and deductions are applied. The amount of income, it's also the amount of income that is used to calculate tax. So you take all universal income as a summary for all the chapters before. IRS does tax on universal income. That total income, in however and whichever fashion you earned it, comes together for line 22, total income. Then there are some adjustments that you can apply to arrive at AGI, adjusted gross income. Then you apply either standard or itemized deductions and exemption dollars to reduce your AGI down to taxable income. That's the minimum amount of income that you have to pay tax on. Then now you are going to use the taxable income to determine the amount of tax you are liable for. Tax rates and percentages are based on taxable income. Now there are additional taxes or additional income that can be included. One is child's interest and dividends. If a child has more than $1,900 of interest earned, could be savings accounts, in any which way. This is not necessarily earned income. A parent can elect to report the child's income on their own return, or the child can do their own return. Understand, if a child makes money, and here in California, one of the obvious options is if they happen to be in the movies, and therefore they make money, but they are a minor, so they would still file taxes, and of course they would not get the exemption. They would be under their parents, but they would still do their own tax return, and of course the exemption amount and everything would go for the parent, because the parent still claims them as a dependent on their tax return. But it doesn't eliminate the child's need to. And many questions that we get from parents is, do I have to report that on my return? No, if it's truly earned income, it's not that the parent has to report it on their return. It's that the child must file a tax return on and report their earned income. But if it's only interest and dividends, then a parent can elect to report that income on their return. And they must use Form 8814. Child must be under 19 or 24 if a full-time student. The child's only income is from interest and dividends. And the overall gross income is less than $9,500 in 2012. And the child had no federal tax withheld from their income. Another form to look at tax is Form 4972 to calculate tax on lump sum distributions. Now this is where a pension or an annuity amounts. A client chooses to have the option to take the full amount of pension or annuities out at one time. This only applies to taxpayers born before January 2nd, 1936. So you probably will not encounter this frequently, if at all. There's only one Form 4972 per tax return. Multiple distributions are lumped together on one form. Another interesting tax out there is called the alternative minimum tax. I love the fancy names they come up with. We call it AMT. Actually, we like the initials AMT to represent because it stands for add more tax. And it truly does. It's an additional amount of tax to pay on preference items. The taxpayer may be subject to AMT based on their income and the amount of the tax on preference items listed below. So if a person makes a large amount of money and has a large number of kids, and that's what they say, addition of personal exemptions. You have 10 kids, so you have an excess amount of reduction in your taxable income. Therefore, AMT can kick in to offset that and you still pay your fair share. Also could be the addition of standard deduction. Generally what you see is the addition of itemized deductions claimed for either excessive state and local taxes deductions, and usually it has to do with certain interest income. So being fairly wealthy, you purchase a lot of properties and you have a lot of investment properties to reduce your taxable income. And again, when it's determined by the IRS standards to be excessive, then AMT can kick in and it will make up the difference and you will still pay your fair share of taxes. Most miscellaneous deductions, work-related, job expenses, and of course part of medical expenses. The difference between a gain or a loss on the sale of property reported for regular tax purposes can also impact and affect your qualifying for AMT. Form 6251 is used to calculate AMT. For further information, you will need to do more research and investigation to speak further on this in this lesson is beyond the scope of this lesson, and there will be additional research necessary. That concludes Chapter 13. Please go to online and do the review questions and the TPAs. You need to pass with a 70% or better, and of course read Chapter 14. Thank you.